This is the Saturday cram school, which I do every third Saturday, 10 a.m. Pacific time. If you want to get signed up for this, go to our event page at simplepassivecashflow.com/events. But today I'm going to be going through the syndication eCourse first section, introduction. And so we'll see how far we get. And if you have any questions, please type it into the question and answer box. So if you guys want to follow along and you have current access to this, you guys can go to members.simplepassivecashflow.com and check out the syndication eCourse section 1 here. But here's the thing, like syndications and private placement, there's a lot of more technical information, but a lot of these things just aren't really in the scope of passive LP investors. I've always said that interacting with real passive investors is the way to do it, right? That's how you really understand what are really the important things. However, what's in this eCourse, I think, especially when you start to dive into sections 3, 4, and 5, you really start to understand at least the beginning stages, learning the terminology of conversion cap rates, what are things to look out for, some nuances in ways people will use different assumptions to, and ways that you can kick out that a deal is more conservative or a pie in the sky dream. And from there, you're never going to be given the P&Ls and the rent rolls from an operator or sponsor. That a lot of times that's never in a pitch deck, and a pitch deck is just meant to be a marketing document. And a lot of times those documents aren't really given out because that's just not what happens in this world. The people who will give it out are a lot of those newer sponsors and operators that, quite frankly, don't have any type of track record, which is why they have to do that type of stuff. If that's not a head scratcher, I don't know what is. But what I would say, learn the stuff so you can learn the terminology and so you can parlay this into interacting with other investors. And I think that's the way to move through this stage 1 of not really knowing what's what and more into understanding. Start off with first, what is a private placement? For the most part, I'm not going to go too much into the structure because there's different ways people structure this, but it really not that important to passive investors because at the end of the day, it's essentially a agreement, a joint, what do we want to call it, a joint venture between a general partner and a bunch of limiting partners, and where the general partner is signing up for fiduciary responsibility, right? A lot of times they're assuming the risks in terms of the debt and being a good steward of all the LPs' money. And a lot of times these documents, at the very essence, signs the general partner up for that. And the LPs, what these documents saying is, yeah, man, there's risk here, right? And like general rule of thumb is when you look at the PPMs, all the boldface type font is all the cut and paste stuff that have been used many times. And the lawyers typically don't even read those things. They just use it from the last one and then the last one and the last one. Realistically speaking, 99% of the PPM document is reused from previous document or the form template that the lawyers reuse. I always question why we keep paying them 12, 15, 20 grand to do a PPM and do all the legal documents for us on every single deal. Because a while back ago, I would always kind of catch an error or two. They would use an FC from the last person's deal. That's just part of the game. They need to fix their template. We haven't seen that in the last several years, though, thankfully. So it looks like they fixed that. But I think investors think the paperwork has to be iron tight, which it does, right? Don't get me wrong. But I would put more emphasis on the people involved in the deal. You can have 99.99% tight documents, but if you're working with dishonest people, your documents don't mean jack. I've been in deals where I was an LP and a general partner, where the people at the helm were just dishonest people. And when you have that, it don't matter what's in those documents because they're screwed anyway. And that's the biggest thing, is that fiduciary responsibility. So the way to think about a lot of these deals, essentially you're buying into a business. And this diagram here is a good example. A lot of times we'll go into real estate deals and we'll buy a real estate asset. But technically, you could go into whatever, right? Like I've been looking at buying businesses, a machinery company or internet SaaS business. You can buy anything and you put the asset into an entity, whether that's an LC, LP, really doesn't make much difference, right? Certain states are better for different assets and in different jurisdictions, but for the most part, the lawyers decide that. It just gets put into an entity and there is a general partner that controls the asset and manages the asset and will also probably sign on the debt, that's what we do. And then the LPs come in, bring their cash, and their job is to fund the monetary part of it. And it's a good thing because it brings the right people together and everybody is a business owner of this entity. And this is combined together through a method called syndications. But when you do this, as you're noticing, there's a lot of passive LP partners. And once you take one person's money of LP money, you've triggered what's called securities law. And that's what triggers all this very expensive documents. Some people who maybe did some hard money lending in the past, what they'll do is they'll tie the investor directly to the property via member loan agreement. That's a lot simpler. It's not triggering securities law because there's title involved in there. But in this case, investors, they are not controlling part of the C, and therefore the securities laws have been triggered. I don't really want to go too much more into the details because I don't want to focus away from really the more important things to spend your valuable time learning about. This also kind of helps understanding why 1031 exchanges are not possible going into this stuff, because you're buying in not a real estate asset. If you're selling a house, you're selling a piece of real estate and you'll be going into a business. If that's the case, you can't do that. 1031 exchanges require you to do like kind exchanges, and therefore you cannot like kind exchange from your real estate property into this business, say it's an SC. And for a lot of people coming in from the tech world involved startups, very similar concept, except there's no assets tied to this thing. There's no brick and mortar. And then I think that in essence, I think that's why I've been drawn to this type of investing, because come hell or high water, there's the real estate asset that, this stuff just doesn't go down to zero. This is why banks like it, right? Because if, the general partner goes AWOL on them, there is the asset for them to collect. There is collateral. And this is why there are other types of syndications out there where there is no asset. There's these pure business loan type of situations, or business or e-commerce businesses or SaaS businesses or content website businesses. Other than the inventory in some warehouse somewhere that's probably worth pennies on the dollars if things happen, there is no hard asset. And again, why we gravitate towards real estate. People ask, is this a new thing? People have been doing this kind of since a really long time. I think a more modern age is you would see guys do this in the country club amongst their close colleagues and friends. However, with the internet connecting people, I think that has really been a disruptor and allowed us to participate in much more institutional assets, and that were really only available to the big institutions like the big REITs, the Wall Street companies. To me, I think this is the really cool thing, that we as average people, we're average Joes out there, we get access to these great institutional assets as opposed to just fighting each other for all these low-hanging fruit with small margins, single-family homes, duplexes, triplexes, or quads, or properties under 50 units that are very difficult to manage. I was talking to a broker, and I remember this conversation, and he was new to all this, like the way we do it, right? Because he typically will sell to larger institutions or family offices. And he's like, you do what? These investors come into these deals, and he was took him a while to think about it. So that's super cool, right? What you guys do, right? Because, man, like before, I'm just interacting with these big faceless companies, and Sure, they're letting average Joes get into their deal in some strange roundabout way later, but then it goes into the REIT, the real estate investment trust, or some other Wall Street product, which, as you guys know, just puts into these layers of all these like middlemen and financial planners and commissions. And yeah, it's really cool that real regular guys can just own direct interest in these assets and also move very nimbly too. We're able to construct and raise capital, construct an asset, get going. A good case in point, like our Chase Creek apartments, a 230 unit build in Huntsville. We started after an institutional group, and that institutional group needed to wait for their financing from the higher ups to approve it in several tranches. And what a lot of those development groups will do is they will fund it with cash flow from other parts of their business. Where the way we do it, we'll pool it all together in a C for liability reasons too, right? So it's all segregated and firewalled. But once it's capitalized, the ship sails, and that's it. There's a misnomer that people think that the Jobs Act had something to do with it, which I believe came around mid 2010s. So all the Jobs Act did was allow for this thing called 506C opportunities. So it allowed people like myself to mass market. But take a great quote from a famous lawyer. She said, what they give you, they take it away. So they gave people the ability, if they wanted to do a 506C offering, is they gave them the ability to go out and mass market, advertise, but they took away the ability for them to just bring in non-accredited investors, and they needed all investors to certify, third-party certify accredited status. We've traditionally not really blasted things out on the internet. I always have to be very careful, not talk about specifically about a deal. And that's why you notice, hey, join the club, get to know us better, book a call, maybe come out to one of our events, test drive the organization out, especially as we've grown, right? And we have probably one of the largest investor bases of any group out there, which is why we don't need to go into all these daisy chain deals that you see out there floating around where everybody is syndicating the same deal. We're able to fund deals on our own and be a little picky, choosy who we bring into the deal. Not everybody is a good fit, but as much as I hem and haw over this, it brings me a little stress. That's just how it is. The way I see it, like my role is to be a fiduciary and do what's best for all investors and do my job right, which eventually getting the investment return and hit pro forma. But we go through 506B offerings, so we don't advertise and we take in investors that we have a pre-existing relationship with. It can be accredited, it can be sophisticated. That just goes with my style, right? And people are in my family office inner circle group. You guys understand how I work, right? It's a closed doors relationship first. Some people call it a little bit of a secret society. Hey, that's just how I roll, right? Like I'm more of a close relationship, a guy, as best as I can with our investor group. So big these days. So the Jobs Act really helped people do the 506C offerings as opposed to the 506B was always there. But even today, like the vast majority, I would probably go out on a whim and say 97 to 90% of deals out there are still done via the old-fashioned way where you can be a non-accredited investor and get in. Whereas the minority, or would I say 10% to 2%, of deals are that 506C offerings, which are blasted out. And that came about from the Jobs Act. So it really is, I think a big misnomer is like, I have to be an accredited investor to get into these private placements and syndications today, and probably for the next decade or two, not the case. It's really the tip of the iceberg. Like you're just seeing the tip of the iceberg above the surface of the 506C deals. Likely people are talking about the deals that are on the crowdfunding websites those are mass marketed in a way on a marketplace. That's all those crowdfunding websites are. They're just marketplaces. And a lot of times it has to be 506C or accredited investor at that point. But they're failing to see what's under the surface, which is the majority of deals that are typically 506B offerings, but you have to be part of the group. So that's what now people aren't seeing. I don't see all the deals out there myself. This is a people game, this is a relationship game, and this is why I'm always saying interact with other purely passive approach investors, and that's how you level up your deal flow. Another way to think about these types of private placement syndications, like a mini IPO. Sometimes they point that out in the SEC documents, but there's ways legally it's differently, but that's the way to kind of think about it. So there's two ways that you can pull together deals, this diagram. So the first one is a single asset LC. So that is where one asset goes in an LC. The other way is a blind pool fund. So a blind pool fund, multiple assets could be pulled into a deal, into an LLC, and investors will be blind to it, as the name suggests. A lot of times in that case, the general partner operator will say, we're going to be going after these types of assets, these types of location in this submarket, or it could be as general as, hey, we're good investors. We own over $1 billion of assets and we know what we're doing. So we're going to go after good deals. Just trust us, right? It could be as broad as that. There's different pros and cons of both. I'm not saying one is better than the other. Typically, people will start off with single asset LC deals, or it can also be multiple assets. We've done like a 3-pack where you put 3 properties in a deal, or several times we've done 2 assets in a deal. But those are examples of the single asset LLC or multiple asset LLC deals. But the key thing there is when passive investors sign up for a deal, and they do all their documents, their private placements, their subscription agreement, their operating agreement, and sign up for a deal, they know what they're going into. Whereas the blind pool, as the name suggests, you don't know, and you may have a little bit of prospectus, and you're putting a lot more faith in the operator that they're going to perform. At the end of the day, I think a lot of more sophisticated investors know, hey, what is the operator's going to get what they're going to get, right? They're going to put the assets in to hit the performance. I am just holding them accountable to what they're getting from me, what's in it for me at the end of the deal. Some investors that are a little bit more hands-on, or especially investors that are beginning and don't have that many deals, maybe have a little bit too much time on their hand, they want to really see what's going into the sausage. And I think that's why some people will gravitate towards a single asset LLC first deal. Some of the cons of both, I would say the blind pool fund is investors, you don't really know what's going in there. And sometimes there's games being played, certain assets are picked up for certain other reasons. But then again, I'm saying it happens out there in the industry. There's a lot less transparency. It happens out there. Like I said, the general partner should always have the investors' mind in first, right? They should always have fiduciary responsibility. The funds, you're having multiple assets in there. Sometimes there's a sales pitch saying, oh, we have capital ready to go so we can deploy it. Yeah, true to some effect. It's a white lie, in my opinion. You should be able to call the capital and get it quickly enough. No sponsor wants to have your money just sitting there, because that just lowers your end returns for investors. And ultimately, that's what, as your general partner, you're being held accountable to. So that's not really a good reason, and nor is that what general partners are doing in the fund model anyway. And when you do that, there's always going to be a little bit of inefficiency use of capital. And this is probably evident in all passive investors' portfolios, right? You guys have lazy equity here. I see a lot of you guys have multiple 6 figures in your house. You got 20 grand in your checking account. You got another 30 grand here, and you got 400 grand in your infinite banking, right? Like most passive investors are pretty inefficient with their capital, right? Their lazy capital is sitting there doing nothing. The fund manager for the syndication wants to minimize that as much as possible. Maybe you have a $10 million fund, but $1 million is just sitting there doing nothing. That is really bad for your returns at the end of the day. And that is what happens in funds a lot of times. And I run into it myself, right? Like we always have a few $100,000 of slush that's going around in the fund. And I try to minimize that as much as possible, but that's just part of the game. Whereas a single asset LC deal, you raise just as much capital, but that's it, right? And of course, you're raising your cash reserves, working capital, but everything goes in there and that's it. Sometimes there's not enough, right? And you may have to do a capital call, which just means you just didn't raise enough in the beginning. There's not capital just dead weight, not doing anything, lowering the overall returns at the end of the day. Can the GP saturate the deal from initial LPs? Can you give an example? Maybe.
So what I meant was for the initial deal, all initial investor say the deal is for $10 million and the deal is sealed, the ship has sailed, like you said, but somehow there's a glitch during that or a blockage or some issue when the ship is sailed and you're bringing in new investors. Can those investors, meaning the second round, can they saturate the initial investors or the LPs? Like a startup, when you have first round, second round investing?
I'm not super familiar with tech startups and that stuff. I know that there's like Series A and all these letters, right?
Correct.
But the way I think the difference in our world is like there's only one round, right? If there was another round, we throw it all out and recast it and resyndicate the whole dang thing, right? Because once that equity is given out, for example, if a deal is a 70-30 split, right? Or LPs are getting that 70%. Once the shares are sold in that capital stack, it's already allocated. And I can't sell any more of that 70%. But if later on down the road, and this certainly happens, right? Like you're going through the closing process and you need maybe a couple more $100,000, right?
Right.
Which is actually that's pretty common, like because we don't know the exact loan proceeds. The lender may say we'll give you 70% LTV, but then come back and give us 68%. And we may need a few hundred more grand and we bring in a couple more investors, right? But that's all in the initial raise.
What about
So
in a scenario where you have the roof caved down and you need a significant of funds to renovate that, even if for example, if your insurance doesn't cover that?
yeah, so what you're describing is like the capital call situation. So at that point, investors would probably be asked, hey guys, here's the situation. It's unforeseen. Like the roof obviously would be, we know about that, right? But let's just say it's some act of God, right? Or
Correct.
something, and insurance for some strange reason didn't cover it. Or here's a more like realistic situation. So like we have a lot of fires all the time, and we have working capital, we have cash reserves, but let's just say the insurance provider is just being a real stickler and just slow rolling us, which we've had happen a couple times in the past. And we're like, hey guys, we need an extra $500,000 for working capital, right? We're gonna get it back once the insurance claim back, but we're gonna do this via a capital call, right? So at that point, we would go out to investors and say, hey, this is still coming from that LP pie. You guys have an opportunity to keep your percent allocation of that pie. So just to keep math simple, right? Let's just say the capital raise was $5 million and you, sir, you put in 500,000 of that. You're a rather large investor, so you had 10% of that. And then the capital call comes out, we're asking for another $500,000 on the 5 million. So that's 10% more. Your percentage of that is, hey, we're going to need an extra 50,000 from you personally. And at that point, say you don't have the money, right? In that case, it's just a simple math exercise at that point. But the denominator is how much capital was in the stack for that group. And then, how much you had. So initially you had $500,000 out of 5 million. So that's 10%. But the stack grew, right? $500,000. So now you have $500,000 out of 5.5 million. So your percentage went down slightly.
So for example, in that example, I would be 10% in a deal on that deal. And if I can't cover that 10% or whatever the difference is, you're gonna give it to somebody else. Say, for example, my money's all stuck in different deals. I can't get it out and I can't contribute anymore into that additional capital call.
Yeah, that's correct. And like, this is tricky part about investing with so many investors with there's very little accountability here. I always move more towards a more cohesive investor group because we all need to do what's right for the asset, right? And if everybody just said, nah, I don't want to do it, then we need to come up with the money somehow. And I think That's what's nice about being a passive investor. You don't really have any recourse there. But that's where I come in. And typically what we've done as a general partner group in the past is funded ourselves. This is how we avoid a lot of capital calls, right? Because there's always stuff that goes wrong.
I think it's good to share that information. At least from my perspective as an LP is I want to be proactive. I want to plan my strategies when I go into deals. So say for example, I'm going to 5 deals and I'm going to allocate about 10% of slush funds just in case there's a capital calls.
I don't think that is really necessary. It's a good thing that you guys bring this up to me because I remember I was talking to an investor a couple of years ago and they only invested in a few deals at 100 grand and their net worth was not much more than a couple million. And I was like, well, do you have this $200,000 here in cash during? And they're like, oh, that's for a capital call. I'm like, yeah, that's not how you do it, man. Other than you like your own personal savings stuff, I wouldn't really hold back any reserves for private placement, especially LP reserves.
That's very good to know. This is very important information when I put it into my plans and strategies.
Maybe I shouldn't be saying that as a general partner, right? But dude, that's why you're a passive investor. You don't have any debt signing liability, signing on the debt. You have no legal liability. And in those types of circumstances of a capital call, I can't really hold your feet to the fire. Be
Right.
honest.
But where, for example, in the past, I was involved with a passive investing in a real estate deal, rental properties, and we're stuck in a pickle. Like if we don't inject funds in here, this place gonna fall through, and we're gonna lose everything.
Yeah. That's why you have me here. And that's why
Yeah.
myself and my partners are pretty well connected. And this is exactly why you invest in a very liquid type of asset class, this whole
Mhm.
multifamily thing. It's relatively easy for us to find outside capital to come in these types of deals, right? Institutional capital, family office, preferred equity.
Okay, that's good to know. So I can maximize my fund instead of having a reserve fund just for any kind of incidents like the scenario we talk about. So I have a different strategies how to use that slush fund. That's
Yeah.
great.
Yeah. And especially if your net worth is on the lower end of most passive investors, you can't be doing that kind of stuff. You got to fight to increase your net worth with all your money. You got to get all your guys working. Now, I'd much rather see you take that money and have it be your own personal reserves, which if you're working a day job, you really don't need much more than 20 grand, I
Yeah, I
think.
agree. I agree. And if you have the infinite banking, you got it covered anyway if something happened with your job.
Yeah, that's the best of both worlds, right? You can have your emergency savings account in there and still
Right.
be making like 5% tax free. That's one of the benefits of that.
Yeah, I
Um,
agree. At least I know where to deploy my money. That will grow. I'm gonna instead of putting it into my slush fund just in case, I want to just put it all into the infinite banking. At least I could use it multiple ways.
yeah, and now you're seeing what we call it like your own bank, right? Your own private vault. And
Yes.
especially with all the late turmoil with like banks going under, which is more of a isolated incident than a systemic thing. Should shake people up into that's why you want to have your own private vault. You don't have to
Yeah.
depend on these kind of agencies.
Yeah. I just love that concept. It just opened my eyes to new opportunities, how I could leverage my money in a more efficient manner.
But I'm gonna confuse you even more here. Maybe I shouldn't do this in the intro section, but there's what a lot of operators and sponsors will do is they'll avoid a capital call because a capital call is extremely embarrassing for a general partnership. You know?
And that's what I was trying to lean towards is get some more insight into
Yeah.
if general partner continues or have a habit or have a history of doing that, I wouldn't want to deal with that general partner.
And here's why I say here's the counterpoint to that. What a lot of people are doing, especially today, right? Because everybody's having capital calls right now. What some people are doing is they're bringing in outside capital and they're not going to their investors. They're not being transparent with them and not asking the investors to put in more money. But in actuality, what they're doing is they're creating an additional investor layer above where you guys are, the common equity. Think of it like a
Ah,
parasite
see,
that
it's like
eats all
a
the
startup.
money. So you're not diluted. You still get your, in their example, you still get your 10% of the LP pie. But this little parasite here that they signed up for rescue debt fund went in and took everybody's gains. So you get 10% of pretty much nothing at the end of the day, or LPs. You avoided a capital call, but you screwed over your passive investors.
Yeah. And when they find out that, they're not going to be happy.
Most investors will never know the difference.
Okay. Isn't there a way to find out? They don't have to share that information if they're bringing new investors.
Technically, I don't think general partners need to disclose that to their investors. I don't really know what mine say, but to me, I just don't feel like that's right. And that's where it comes
Yeah.
down to like value system and like honor and honesty.
Yeah.
I don't care if
And
I'm
it
the
goes
bad
back
guy.
to your point is you want to create that tight niche of people where you understand and you know how they operate and their morals in terms of everyday living.
Yeah.
I totally get it now.
I've seen in another deal where some investors, and this is why we tell people like go through this eCourse, right? Learn the stuff so you can understand a little bit of the nuances, like this next one. There's preferred rate of return. Some investors only invest if there's a preferred rate of return. I think this deal I'm talking about in my head, there was like a pretty high pref, like a 11, 13% pref with an equity waterfall at the end. But the investor, the general partner operator needed to raise capital. So they bumped up that pref to entice investors in, which ultimately just kicked his problem down the road. That deal, it was a development deal and it hit the pause. They ran into some permitting problems, which is pretty common with development deals that aren't pre-developed, which is why we try to go into sites that are already ready to go when we buy it. But they ran into the problem and the deal kind of stalled out for a couple years. But all this time, investors are piling up that pref. But it's a false sense of security because if you ain't gonna make any money, your pref doesn't mean nothing. So this thing was building on the operator and it got to a point, and this is totally wrong, right? But from the operator's perspective, they're like, all right, I ain't gonna never make money with this thing. So what they did is they sold it off to another group and they got bought out essentially. But it was really sad. The reason why they were able to sell it off is because they were finally going to get going. It was going to finally time to make money, but they sold it off so they could just recoup their pref and make a little money and be done with it because the GP just went into a bad structure. And I think this kind of illustrates the first point of a passive investor. There's always two sides to a coin, right? It's not just, oh, you always want to go into fixed rate debt, Fannie, Freddie Mac, non-recourse.
Right.
You know, there's always three sides of the coin, I always say, in all this stuff. Or like, you always want to have a high pref. In this case, this really screwed investors, right? They didn't even know about it. Or you really want a good split. If there's a low split and a general partner has all these deals, guess which one they're going to just forget about and not care about because they ain't going to make any money. So this is where I think this speaks to the way we structure deals is very like boring and transparent. So typically there's all these tiers and waterfalls. It's just straight split from beginning to end. It's just investors get all the backside.
Yeah.
As
Yeah. I compared with other crowdsourcing website. Man, their deal structure is so wonky. I don't even understand. It's like going down a rabbit hole.
Yeah. I forgot to mention that. Thanks for reminding me. But I was talking about in the beginning of accredited, non-accredited deals. So the crowdfunding websites are just marketplaces. They are just broker dealers. There's a little bit of a false sense of security with a deal being on the platform, being vetted or not. Make no mistake, there's a middleman there, right? And there is fees. We've tried to use those types of crowdfunding websites to raise capital for us, but when I make the inquiry, I'm like, geez, you guys charge what? So I really scratched my head and who's going to these things? Plus, when you go to those kind of platforms, they only raise, I think like a few million, 5 million, which is just not enough.
Yeah. Yeah.
And
They just want to entice the small guys that doesn't know anything.
The most annoying investors, and because there's the middleman involved when they're like, I won't get the names, really the number, or those investors won't pierce through that middleman and come to us. You know, people are familiar with the turnkey rental world, right? There's these turnkey marketers people are saying, I bought a turnkey from rent to something or turnkey, whatever. And I'm like, oh yeah, but who's really doing the deal? Like, that's just the marketer. They're just pumping up the price and taking a fee. Same thing in the crowdfunding website world, right? Going back to that other, that example of the dark side of prefs. And I think that is actually in section 4 there too. But that's an example of there's always 3 sides of the coin when you guys go through this eCourse. The whole point is to learn both sides of it and see it both ways, because there's never really one way. And then after a while, you get to a point where you have a broad understanding of kind of everything, and you just take things for face value. And then when you look at a new deal, you're, oh, okay, it falls within these parameters. And then no deal is going to be perfect. Just because somebody does this thing I'm saying to look out for, doesn't mean you shouldn't do it.
At the end of the day, we have a good framework to work with where we could quickly evaluate deals as a framework. It's not something that is rigid. So it's a good starting point.
I say bridge the gap. This is the bridge that you to finally interact with purely passive investors. And that's where I'm pretty confident there's really no other organization like ours.
And I agree. I haven't seen anywhere that provide this level of information where you start off with a W-2 workers, have no knowledge of all this, how this syndications, how these deals work. And to dabble in it is like a nightmare. It'd be frightening for people, but this is a good starting point. And I think when I first started here, I think I would be better off, or I could learn faster if, say, for example, if you're a newbie, here's a structure you need to do. And if you have all these investment accounts, so IRAs, 401ks, and whatnot, here's what you need to do to get it out into these deals. So I have if you're familiar with engineerings, we have checklists. If you're a newbie with this range in salaries or assets, here's a typical framework that you would follow to build your network up to, say, $2 million.
And here's where I struggle with this whole topic. This not only this, the syndication eCourse is one eCourse amongst the big one, right? It's just one chapter. But if you guys go to the end, there's a syndication due diligence scorecard and checklist. It's a cool spreadsheet, but please do not use the thing like it's how it seems like you're supposed to use it. Just go through it. You can see how I weight certain things, but please don't use the thing in when you actually look at deals. I think that checklist is like the answers in the back of the book, but please just glance at it. It means, I don't know, maybe when I went to school, I was looking at the answers in the back of the book first.
Yeah, same here. I'm that kind of guy.
Yeah.
But I get it. You take it with a grain of salt. Use it as a framework, but don't get stuck in those criteria has to be there. Different type of deals, different structures of deals, you could have flexibility. And like you said, that's where your family office group will provide additional support in terms of their experience with dealing with those different deals.
In our ecosystem, we have a lot of smart people, but even smart people, they're spread on the spectrum of some people, they take everything like without any salt, and they're just not really calibrated, especially in the beginning. And that's why it's always nice to have a good buddy around you to ask the stupid questions to get calibrated with somebody who, is in your corner. And then some people are the opposite, where they just don't even care about anything, and then they just invest. I always feel like there's a good, nice middle ground in the middle, but it takes a little bit of self-awareness to understand which one are you, where you are in the spectrum. But I guess that's in any curriculum. That's the struggle. It keeps things a lot more entertaining than just me going on and on. But throw you back I'll throw you back in the audience for now. But that's actually how I started this whole thing. I remember back in like 2015, I would sit there with a piece of paper written out. It was in Excel, and I would teach people how to buy rental properties. And there were no pictures and no GIFs. It was just me just monologuing about investor stuff. But next thing, a credit investor. This is pretty basic. Again, I think most investors, they focus in on being an accredited investor, but it really doesn't. Like I said, most deals are for non-accredited investors. You just have to find the people. And again, it's a people relationship thing. Oh, we already talked about this, but this is kind of a cool visual of what tiers people are buying properties at, like in the spectrum. I think part of the cool thing about syndications is it allows us to go after 20 million to $100 million range properties, which keeps us above the mom and pop investors and slightly above the little guys. So there's a nice little like void and less competition in the stratosphere. However, there is a lot of competition, new guys trying to make a name for themselves who bought rentals for 3, 4 years and now feel like they can buy a multifamily apartment complex. And now I'm realizing why you don't see people doing this more than 5 to 10 years, because they gracefully drift off into different asset classes or into more institutional spaces and or become more of an institutional operator, and why we've kind of gravitated more towards development ourselves than screwing around with the 100 unit class C building or even class B asset value add. It is more on the personal finance side. If I were to paint the big picture here, right, like how does this all fit together? Well, imagine your portfolio being in $100,000 increments spread across dozens of deals. To give people a framework or starting point, not saying this is exactly what you should be doing. Most of these deals, they last about 5 years, right? Plus or minus several years, right? But on average, 5 years. If you were to go into a deal every single quarter, right? So for a year, for 5 years, that's 20 deals that you'd be in for 5 years, and they would be spaced out. So ideally, they all kind of exit out at different times, which we know is not going to happen, of course, right? At the end of the 5 years. You try your best, right? But you have this pipeline of 20 deals, and then you're getting these 20K ones and 20 times 100 grand. So you have a couple million deployed from that. I think that's a pretty nice like mental model to think about, that you're going to have deals go full cycle, and then when they sell and you have the depreciation recapture and the capital gain hit you, you're going to have plenty of passive activity losses to offset it, and then you'll have the time to replace it and replenish it, and you're not going to really have to worry about paying any taxes or ever have to doing some silly 1031 exchange. I think that's a great way of beginning with the end in mind. And then at that point, you increase your minimum investments. I think why some investors would like to put in more than $250,000 with us. It's typically, maybe it's an unspoken thing, but investors put in larger amounts. We usually give them some extra bonus shares because it's a lot easier to wrangle up one investor who trusts us already than 7 other newer investors doing the minimum. And there's a lot less administrative costs too. So that's why we do it on our side. But I think from what I've seen from more experienced investors who've taken the journey going through this, you start off with 10 to 20% of your net worth. You're dabbling in this, you're trying it out. For a lot of people doing this, it's very much your first foray into alternative investments. And it's different. And especially if you don't know anybody who does this stuff, it can be very scary. And yet, of course, it all makes sense, but you may have nobody in your personal network who even does this type of stuff. And I myself, I didn't know anybody who was an accredited investor back in the day. And most of our investors don't, right? Most of our investors are first generation millionaires, the first person in their families to hit $1 million net worth before the age of 50, 55. Right. Let's face it, if you're good with your money and you're safe, it's pretty easy to just put all your money in your home and hit $1 million by the time you're 67 years old. We're not talking about that type of wealth building method. We're talking about growing your money in alternative investments, paying less taxes, and doing infinite banking to expedite the wealth building process. But investors doing it this way, I'm talking about this 20 deal mental model, but it really starts with that 10, 20% of your net worth into alternative investments. At least this is what I see from our many investors, how they do it. And this is where I really try to not meddle. You guys make your own decisions. My recommendation is interact with other past investors who walked this path before. And that's why we have our inner circle or mastermind group for that, to expedite it. But for people who are just diving in, dipping their toe in, 10 to 20% of your net worth, and you let it ride for 2 to 5 years, enough to see some of these deals go full cycle to either refinance or sell. Some people say It's a little slow. I get it. It's totally prudent. A lot of our investors aren't stupid. You guys aren't the ones that buy late night infomercials or pay $50,000 for some random coaching program on the internet. You guys don't do that. That's why you guys have high net worth. And you want to see proof of concept, or maybe you just don't want your spouse to kill you, right? After that 2 to 5 year period comes the next stage, which is you expand that, right? From what I see with people who are above $3-4 million net worth and not 55 or older, they did not get there unless they had a business, right? Most people don't have operational businesses. The way they did it was they increased the amount of alternative assets that they own, right? Why? Because in alternative assets such as real estate deals, syndications, they have better returns than traditional investments. And they typically create passive income from you. And especially when you do real estate, they will create passive losses for you. And that allows you to pay much less in taxes. So when you combo those two factors in there, that's where the net worth acceleration is happening. And people are not able to drastically grow their net worth past 3 million plus unless I see they typically have 40 to 80% or more alternative assets. And I say that's a big spread in there. Look, if you're a doctor making $400,000 or $500,000 a year, you may be cool doing 30%, 40% into alternative investments because you have so much money coming in. But if you're somebody under $2 million net worth, then you don't have a phenomenal salary, you're going to have to go over the 50, 60% alternative investment part. And that's me, case in point, right? Like I didn't make multiple six figures. I started with zero, right? I paid off some student loans myself, but like from the start, I ratcheted up my alternative investments to 90% plus of my net worth. And that was how I accelerated my net worth generation. Today, I still have, I would probably say 80, 90% alternative assets, partially because I'm the general partner and I believe in the stuff, of course, right? The other rest is life insurance. But I just don't believe in traditional investments. The secret is, and this is what we teach in our family office group, once your net worth gets past $5 to $10 million, you come back to traditional investments. But if you're under $2 million, forget I said that. Completely forget I say that. You guys need to grow your net worth this stage and get at least to $4 or $5 million net worth. Before you start to go back to traditional stuff. But that's my soapbox on how this stuff, the syndications, important to learn about, but that's how the piece it plays into the big world. Single family homes. I think a lot of people have come from that, understand the headache, just not scalable. I had 11 of these things giving me a few $1,000s of passive cash flow a month, but that's just not enough for what most of you guys are looking for. Most of our investors are looking to get that to that $10,000 passive cash flow number a month, and then to that $25,000 a month, which is more ideal. But I think where the syndications really trump the single family homes is the ability for you to re-roll and reallocate your money. The article I would say to understand where this is coming from is simplepassivecashflow.com/ROE. And it's this concept of return on equity, where you don't want to pay down your rental property and not go to debt and not have debt on it, because then your return on equity goes to the low single digits at the end of the day. What we want to do is manage our portfolio so that we're constantly pruning our portfolio so we create multiple of these C curves. So when it drops to be about 15% or less, we sell, refinance, get the leverage point back up effectively, and just get that point high and then ride that C curve again back down. For you engineering types, that's the area under the curve, right? When you get to this point, there's very little area under the curve. That's why we want to keep doing this. But with single family homes, this is very hard. And you make your brokers and your lending brokers very happy because there's a lot of transactional fees that are happening, or what I call friction costs. But with the syndications, we do all that for you. And the big difference is we're doing the value add too. Whereas if you did this on your own, the single family home stuff, you be doing what a lot of the young people are doing, the burst strategy, buy, rent, rehab, refinance, which is high liability. Now you're fighting with low level contractor and you're taking on all that risk, and it just ultimately becomes a job for you. A lot of people talk about how successful it is. I think once you do it a few times, you realize what a crapshoot the whole endeavor is. And if your net worth is under $500,000 and you don't make a professional salary 6 figures, then I think you should do it, right? Because your time isn't valuable at that point, as mine wasn't at one point either when I was starting out in my 20s. But for most of our clientele, especially accredited investors, doing the first strategy is just too much risk for how much reward you could potentially get. My whole mission with this whole the wealth elevator, it's called the wealth elevator because there's multiple floors to this wealth building journey. And I really wanted to differentiate like certain floors, right? Like some people, they don't make a very good salary and they are in credit card debt. They're not even in our world. Not that we don't like them or anything like that, but that's just not where we give them a good strategy, right? But for people who make a professional wage and don't spend more than they make, there are a certain set of strategies like buy a rental property to get started. As soon as you start to make more money at your day job and time is probably more spent either with your family or getting raises at your job, it probably makes more sense to dive into these syndications of private placements, which is like the next floor in like the wealth elevator. And then you progress from there. There's multiple floors. And then when you get the $4 or $5 million end game, there's a different set of strategies. That's the whole concept of the wealth elevator, and syndications are just one part of it. It's a big part of it, I think, for most of our clients, but it allows you to get a lot of these pros of investing, the taxes. One thing I would probably differ on these days, like cash flow, you get some cash flow from deals, but if you're investing, if your net worth is under a couple million, few $1 million, then like you need to be investing more for equity growth. And you probably should still be working your day job. And this is what I've discovered is just from my own passive investing, being an LP myself. Some of these deals, I got 100 grand in and I get my distributions back every quarter. And I'm like, oh, geez, that was like, I don't want to sign so high and mighty, but I think all of us can agree, like $1,500 check, quarterly distribution from that couple grand. That's what was advertised, but it's just insignificant. And that doesn't change my life one bit, even if I had several of them. So it brings up this point that a lot of my higher level investors have said, and where it's, yeah, Lane, I don't really need the cash flow. I have enough money coming in from my day job. And the day job is how I'm able to compile $100,000, $200,000 a year to put into even more investments and accelerate this even more. I don't need the little cash flow coming from semi-stabilized value add deals. And I take that to heart and internalize it. And I totally agree, right? We don't need the cash flow. So I think the cash flow comes at the end, right? Once you build that equity pile, and then you convert it slowly through an asset allocation mix percentage to cash flow. Yeah, I think that's why to me the developments are line up better for especially people under a few $1 million net worth, to grow your money, especially during the years where you're still working your day job. It depends on your goals, and you may want to divvy out your asset allocation mixes based on what you want. I've seen all kinds of things from people. Everybody's got their special spreadsheets. Some people have 10% in developments, 20% in more yield type of deal, the rest in more value add type of projects. I don't know if I would necessarily agree with that strategy. And of course, you don't know that person, you don't know what their goals are, how old they are, what they make of their day job. But I think this is exactly why you interact with other investors. I think initially the draw to interact with other investors is to understand and talk about these things, specifically about what deals to invest in and these syndication topics. But that's why I got to try and trick you guys all into interacting with each other, because you build those relationships and then later on you discover hey, these are my friends that I can interact with and bounce ideas off of, like how we're building our portfolios or asset allocation mixes, more developments versus more of this. And then later those friendships blossom into, hey, how's your kids going? Are you gonna give them $1 million or $4 million to this trust or that trust? And then in a very short period of time, maybe even 10 years, then those discussions go even more deeper, right? Maybe your kids or your grandkids are hanging out because they're the only rich kids on the block that have any conscious sense of money. That's why now you're seeing the need for the family office, right? A group of our family offices that all hang out and teach the next generation. Because a lot of these deals out there, these are not audacious return performance, very reasonable, backed by real estate. Double your money every 5 years. So if you have $1 million now, in 5 years, that'll be two. In 5 more years, that'll be four, and you're done. Should be done, right? Of course, it all depends on how much money you put in. And then, like I said, most people only start with 10 to 20% of your net worth. So you're going to probably take another extra 5 years plus on top of that. So probably take an average guy to get 15 million, but take you 15 years to get to that number, that magic number end game I said prior. But hey, that's just what most people do. Like I said, we have some people in our group that have just totally jumped in and just put everything, and they are financially free right now and they don't work their day jobs. Maybe a little bit risky if you ask me, right? But some of those people have joined the family office group and gotten themselves around the right people to, and what's a little bit of insurance for them to just jump right on into the deep end. That's how powerful this stuff is. And especially when you're not paying taxes along the way, you're quickly realizing you can get to where you want to be. And for most people, like I said, it's 4 to 7 years. All these problems you're worried about money go away, and now it starts to become more about legacy creation and keeping and teaching the next generation, because it's pretty easy to get 4 or 5 mil plus and then to keep going on and on. And if you have 2 or 3 kids, they're each going to get $1 to $3 million. And that's why I argue whether you give them $1 million each or $3 million each really doesn't matter. In fact, the more money you give them, that if you're $1 to $3 million each kid, $9 million split three ways, three each kid, that actually probably is a bigger detriment to them. What is the bigger impact is you teaching them the financial education skills that we're talking about right now. But more importantly, the relationships that you created now and how those kind of blossom in the future with not only the person you're interacting with, but the next generation's connections on that side. Not saying we're doing any matchmaking with people's families or doing anything crazy stuff like that, but I would bet it would happen one of these days. Syndications are a great way to diversify in different people, asset classes. There's all these other asset classes out there. I'm a big fan of just the whole thesis on the workforce housing sector, the narrative of the rich are getting richer, the poor are getting poorer, and this shrinking middle class is being pulled more to the lower middle class. I'm not saying that it's right. I'm just going to skate to where the puck is, as Wayne Gretzky says. So that's why I personally like multifamily housing in the workforce sector. There are other things such as self-storage, mobile home parks, assisted living that kind of exist in our world. I'm not a huge fan of assisted living because it's hugely predicated on the operator, and I haven't really found any good operators doing that. Mobile home parks is a little bit on the lower end of the tenant clientele scale. Self-storage, not a huge fan of that because all self-storages need to be really class A. And I think that's the beauty of apartments, right? Like, if you go into a class B asset and then something new gets built across the street, doesn't really compete directly with you. It helps you as they push their prices up to 1,800. Now your $1,300 apartment seems so much more better and more value. Whereas self-storage, they all need to be class A because they all need to be a certain level where people feel safe and it's clean, because of the price points are so low anyway. That's partially because of it. Where, now if you have a new self-storage facility built across yours, which is very easy, it's easy to construct a self-storage facility. now competes directly with yours. Geographic markets, you're able to jump around as different trends happen, diversify your portfolio, and then now you're able to diversify on different business plans. Like I said, the 5-year value add type of deals, which in my opinion is probably, I see them these days as more risk than your development type of deals, just because there's so much more competition and people are beating each other up. The pricing isn't as good. And as we've seen, you go through the pandemic, eviction moratoriums, and then interest rate hikes, and you feel all these little bumps in the economy. It's like hitting out in your Jeep across the safari. You feel every single bump. Where developments is you just airlift yourself up in a helicopter, you drop yourself 3 years down when the deal is over. But you can diversify yourself through different business plans. Now, some people key in on with our developments that we try to do is we try to refinance our money back so we don't have any skin in the game. And so it's just infinite returns is the concept. People try and key in on. I would say don't worry about that type of stuff. I think if you're worried about that type of stuff, you need to be in more deals. An interesting phenomenon happens when you start to invest more than $500,000 million into more than a dozen deals, is you stop worrying what is happening with these 1, 2, 3, 4, 5 of them. You start to view your portfolio more as a whole. Whether one refinances or sells, just cashes out, it really doesn't make any difference to you. And I'm just going to take, if something comes out, you're just going to replace it in some other asset or other. That's, I think, where you want to gravitate towards. But in the beginning stages, you got nothing better to do than watch your one thumbtack here, a few here, there. So that's very natural for that to happen in the beginning stages. Yeah, we talked a little bit about this. There'll be open-ended fund where the fund manager can keep adding assets into it. So this is where there might be an opportunity for new investors to come in or existing investors to add to their investment holdings. Most of the deals we do are closed. There's only one load period. After that, it's closed. Every deal is just a little bit different. Doesn't really matter too much at the end of the day. I would say if you get your investor who gets gummed up on these types of details, just skip to section 3 or the next section. I really don't want people to get too much gummed up with these types of details because this is really not it's really not part of investor due diligence. I think if an investment is sound, that's really what I kind of key on, is an investment sound. Sure, some lawyers will tell you to look at this type of stuff with that type of stuff, but to an untrained eye, it can just be a real time suck. And again, you should be investing with good, honest people with a track record to make sure that doesn't happen. But maybe I'll explain how we do it. It's very typical. But you'll have the investor entity up here, 123 Main Street, LLC. That's what everybody will own a percentage of. So you might have, I believe, so this is the management entity. So that might be like the general partners in there. And that there might be multiple general partners. And then there's the class A and then the class B. So class A would be the passive investors, the LPs, and then the class B would be the general partners where they own their sweat equity portion. But for the most part, yeah, that's pretty standard. There are some other arrangements, especially, but I don't know if it's too important. Liability, the nice thing about being a passive investor, being a limited partner, as the name suggests, limited liability. A lot of the liability falls on the managing member or the general partner. If in case there's ever a lawsuit, we've had multiple lawsuits filed to the investor entity, of course. Sometimes they'll name us as managers, but I think, again, that's why you don't really have to worry as a passive investor. Most of our passive investors will just invest out of their own personal name. So this is talking a little bit about a KP. So a KP or key principal or is a person who will sign up as the personal guarantee person for the debt. So generally, there's a bank note and the key principal group, which is a portion of the general partnership, if not all of them, will sign on the debt to get that note. And the KPs need to have a combined net worth greater than or equal to the loan. So if we're getting a $50 million loan, we need to have guys signing on the debt that are 50 million and greater. We have 5 guys that are $10 million each. That gets us in. There are also some liquidity requirements, but this is where we always are looking for people who are looking to sign on the debt with us. You got to be more than $5 million net worth. But this is a way that some investors have found to just go around and John Hancock their way to making some nice money here and there, like certainly 5 figures here or there for not really doing anything. There are some risks, of course, to that, but that is what a lot of more sophisticated investors will do, but very rare, but that's what this is talking about. Oh, a question here. How would you recommend LPs go into deal a joint self LLC trust? So a trust is, or yourself is pretty much the same thing. It's not an entity, so there is no legal protection there. If you want to come off here and ask this, but I'm going to preface everything I say with I'm not a lawyer. The lawyers may tell you something different. A lot of times they'll try to get you to do some kind of complicated family holding LLC thing. But as far as investing as an LP in a syndication, there's really not much to worry about as far as liability. You are not a managing member.
What about in terms of tax efficiency? Would you prefer to go into an LLC and then get taxed with an LLC as an LLC or self?
Glad you said that. So this is a huge misnomer. Entities such as you're talking about have nothing to do with taxes. Exception if you're doing like an S Corp, C Corp, but most of you guys are never really doing that stuff. But yeah, like whether you have an LLC or not, it all flows down to you personally. Does that make sense?
Yeah, I heard where there's an LLC where you form in Wyoming where it keeps your identity anonymous.
Yeah, so you saw that YouTube video too, right? Who cares if you're anonymous? If you get sued, you're gonna get subpoenaed anyway, and you got to be truthful. It doesn't even matter. All that does is makes it be a little bit more harder to find from snooping eyes like your neighbor, but it doesn't really provide you any type of like goal. And again, that's just a great example of guys, a lot of investors, they deploy a good amount of funds and they're in this 2 to 5 year waiting period. You can really drive yourself crazy by watching all these YouTube and podcasts. YouTube podcasts, especially after the year 2020, because a lot of like the guys who would do those infomercials or the scam conferences, they couldn't do conferences anymore. So they started to do podcasts. And the industry secret these days is like podcasts are just marketing opportunities for everybody's. A great way to get started for free, right? As just getting information. If you've been investing and been deployed, I'd be very cautious. So just take everything with a grain of salt out there that they're all marketing tools for people, including myself. I'll be transparent that you got to get around other investors doing this stuff. I mentioned that 5 times, so I'm not going to go into it much more. But that video is a great example.
I know their entities are like way overpriced, like $2,000. I'm like, what? I could do that online for a fraction of that.
Well, then I wouldn't do it. If you're gonna do it, then do it. It's where I come from.
Yeah, and I get it. That's just one example. You're like, if you could go somebody in Wyoming and look up an attorney that specializes in that, it's a fraction of that.
Yeah. But I think where I'm coming from and like where the idea of the wealth elevator comes from, it's like depending on how much net worth you have, quite frankly, like an LLC would just be a waste of money. For example, if you're under $500,000 net worth, nobody wants to sue you. You're broke. You're not a good target, right? So why waste your money with all this stuff?
So what happened in a scenario like us in our group? Most of us are accredited investors.
I would probably say what most people are doing is they're just doing it personally, right? But if you are like a high liability profession, like a doctor, then you might want to use an LLC. Like I said, if you look at that sticker price, couple grand for an LLC, and if you don't think twice about it, then yeah, sure, get it, right? Or you just stay up at night worrying about this stuff. Just get the damn thing. Right? It's not that much money.
Yeah, but and I agree with you. It's a bunch of scare tactics for people to protect themselves. But at the end of the day, like you said, if you get sued, you have to have full disclosure.
Right. So that anonymity thing goes out the window. Unrelated example, like the irrevocable trust that a lot of people will get when they start to go 5 million, 10 million net worth and above to escape estate taxes. A lot of that stuff will cost like 30 grand to put together. And if you're, whoa, that's a lot of money. You probably don't have $5-10 million, right?
Yeah,
Um,
true.
the thing about the entities, the simple LLCs too, you may get them. You may be, yeah, fine, pay $2,000, but it just complicates things and is a pain in the ass to do it right. A lot of times people just mess it up anyways. It's like they don't even, they brick their own entity in a way because
Yeah.
the lawyers, they sell you it, but once they sold you on it, you never see them again. It's only just you and your LLC. One concept I would want to talk about is that what are you worried about, right? Is it the outside in or inside out liability, right? So what I'm talking about, you have a rental property. If you have any rental property where you own direct ownership, I would highly recommend an LLC owning that thing, right? Because you're on the front lines, you're direct ownership. You're worried about slip, tripping, fall, wrongful death, whatever, and suing you. So I would consider that the inside legal threat, which isn't really present in these syndications, right? You're an LP. So you don't really have to worry about the inside attack. What you got to worry about is the outside attack. Like if you go down the street, hit grandma on the way to the grocery store, or of course, we don't go around doing crazy things, right? That's a big part of it. And then, of course, everybody should be having umbrella insurance, at least $1 million or $2 million of umbrella insurance. I repeat, that is the first thing everybody should be doing before even worrying about any of this type of stuff. But that's what you're really worried about, right? If say there was some wrongful death, frivolous lawsuit, and at least maybe you're able to have your holdings in an LLC to provide you some protection. But if you're personally owning that LLC, they're just going to grab your syndication holdings anyway.
I agree. And they're using a lot of scare tactics. And I guess my question is, what is the best approach when we're dealing with syndication, as myself or as an LLC?
If you got the LLC, use it.
Okay.
But that said, make sure you don't have things in that LLC that are like other rentals or businesses, because that's the worst.
Typically, different rentals, different LLCs.
Yeah, I say that because I had one case where a guy, I don't know why I asked the question, because I knew he had a business. I'm like, you don't have your laundry business in this LLC, do you? He's like, yeah, it's my only LLC. Like, don't do that. Yeah, I'm not a lawyer, but don't do that.
Right.
Because any liability that comes from his business, they're just gonna take his syndication holding because it's in the same dang LLC. But yeah, if you don't mind spending a couple grand and a little bit of a headache every single year, then do it. You got $1 million, $500,000, then do it. But I don't know, if you like to complicate your life, then do it. But maybe if you're like, I want to grow into something bigger and eventually put it into irrevocable trust, then maybe that might make things easier down the road. Sure. But yeah, if you don't mind spending a couple $1,000 up front and or the stuff kind of freaks you out, sure, go and get the extra protection. Just do it.
Yeah, I'm just doing some research on that, and there's some of the information it's not transparent. It's just more about scare tactics, like you said. So I'm just trying to figure out what is the best approach. Is this getting my main goal for the next 5 to 10 years is syndication passive investment. And with that in mind, how should I go into deals as myself or as an LLC?
Part of my whole shtick on like LLCs is they're not super effective. Even if you have it, it's relatively easy for a lawyer to just pierce the corporate veil.
Right.
And that's partially where I'm coming from. But I think more often than not, this is something that trips up a lot of investors, and it's just a way to procrastinate doing what you're actually supposed to be doing. Not saying that's the case, but just get the damn thing and move on. Pardon my crudeness, right? But I just don't, if you have $500,000 doing nothing, $500,000 at 12%, 1% every month, you're losing out on What is that? So yeah, 12%, that's $75,000 a year every month that you're hemming and hawing. Should I do an LLC? You're losing like 6 grand.
Yeah. No, I don't take it personally. I appreciate sharing the
Yeah.
knowledge and stuff like that. No, I don't take that. I think it's a good discussion around that. And there's no way I'm gonna be an LLC is a showstopper for me. For me to think, is it a better way to do that or is it not? So far from my research, it seems to be a lot of maintenance. And then from the initial, yeah, you could create one within a day or two, but it's the ongoing maintenance of that and the upkeeping versus the amount of protection. It's from my thought, it's not very worth it at all.
I would say if your net worth is 1 million, just get the damn thing.
Okay.
Yeah.
So would it be safe to say that joining these syndication as a joint or self has sufficient protections on top of whatever the deals has? Like the
Yeah.
topic that you mentioned earlier here is investors, LPs has protection from liabilities. And that's when I jump in to ask the
Yeah.
question.
Yeah. But it's so cheap. Just get it. That's where I'm coming from too.
Okay.
You shouldn't spend more than a week deciding this thing.
Yeah.
Because every
Okay.
week you wait, you're wasting $1,500. Could have just bought the damn thing to begin with that, right? That's where I'm
True.
coming from.
True.
But what is another question that comes up is, hey, do I do it in my name? Okay, what if an investor's, yeah, I don't like, life's too short, screw it. I get it. I don't want the
Yeah.
LLC because I don't want the headache.
Yeah. And
I'm more into living my life and then screwing around with all this stupid paperwork and lawyers. I'm like, yeah, okay. But if that's what you want to do, that's what you want to do. So then the question is, do I sign on behalf of myself or my trust? And from our perspective, doesn't really matter. You should have a trust. Everybody should have a trust. So you don't go into probate. But whatever you sign in your own personal name should flow down and be in to your instructions in your trust. That makes sense.
yeah. Yeah. No, the trust, I totally get it. And that's the best protection for for your family against the probate stuff.
Yeah,
Um,
yeah. But a
yeah,
trust offers no asset protection. Let's get
correct.
that clear for
Correct.
everybody.
Unless it's irrevocable trust. So
And
yeah, I'm a guy that really likes to dig into the pros and cons of things. And that's why I spent the last week looking at LLCs and I'm not sure if I should get that or not. But like you said, some places cost 2,500. There's places that actually in Wyoming that costs like $300.
yeah,
Yeah. But yeah, thank you very much for the feedback. So far, I've joined some of the deal as joint. I don't have a problem with that. It's just for future deals on what is the best approach for that.
yeah. As far as like joints, right? Like rights of receivership, I have no clue what those things mean. But what a lawyer told me is all those things are old school type of things. Some of the old school lawyers actually think that it's anything. It really doesn't. At the end of the day, we know who you are. We're gonna find the person who it needs to go to.
Yeah.
Obviously, if you're not around, I'm going to need to see the marriage certificate of the person who I need to be talking to or the trust document. So I don't just give money to somebody, some random person in your family, of course.
Yeah.
But
And my point is, I join as I apply those deals as a joint. That way, I have my spouse information there readily available, just in case. It just removed that level of searching for who my spouse is and communication wise.
yeah,
That's
yeah,
mainly for that purpose only.
yeah. We've never had a person die on us yet. I'm sure it'll
Well,
happen, but I guess that's why we're here, right? And that's why we say relationships again, because when stuff like that happens, most times your spouse is not anywhere near the level of sophistication you are. But if you have those relationships in your back pocket, at least your spouse or your kids can go to these people and then get different parts of the story.
yeah, that's a very good point, and I'm glad you mentioned about that. And that's something on my mind as well. If I kick the bucket, how's my spouse going to handle all of this stuff? And it's good to have that network to support.
That's why I'm like, I tell my spouse, hey, come out, hang out with the family office guys. I have somewhere written with more than a dozen people that she should talk to in case I kick the bucket. Because I know on my top 12 list, a couple of them are a little out there. So I have multiple data points, right? To piece together the mystery.
Yeah,
But I think that's important. And at the end of the day, I'm sure if you build a relationship with somebody and something happens to another one of your compadres, fighting, like you or anybody would step up to bat and do what you can to help that person, even if
yeah,
it is for a fleeting moment, an hour phone call or whatever, or be a resource. You'd be amazed. There are a bunch of like widows and I don't know what widow guys are called, but people who have a lot of money, got access to it, and then somehow found me. And my takeaway from that is, wow, they come in and they come in hungry. So they educate themselves on all this type of stuff and they're very conscious, but they didn't have any awareness of what was happening within the family finances because the other spouse did everything. And boy, are they in a vulnerable position, I would say. Luckily, they found me. I tell it to them straight. And we have all this kind of content for them. And then they met other people, right? Some of these people will join the family office group so they can build their own relationship. But
yeah, yeah.
these are the people who successfully jumped that gap, that
Right.
bridge. But man,
And
are people vulnerable out there to all these types of scams? And what do you
yeah,
do? And they end up just putting their money with the trust person in the bank, which is the worst. You think retirement accounts are bad with the fee structures? The trustee accounts are absolutely way worse in terms of their fee structures. And it makes
well,
so much sense because at that point in your life, the survivors are absolutely such at a disadvantage in terms of where they can go with that money.
and then I'm so glad you have those apps to connect with other investors. I haven't had a chance to go to one, especially the current one that's coming up, but we're really looking forward to that. And the one in Hawaii. I want to introduce my wife to the group or to whatever I'm doing. At least she knows what I'm doing, the people around there. If I were to kick the bucket, at least she
Yeah.
has some support groups that understands what I'm doing.
This is the way to do it, right? You don't want to take them to some slimy meetup or real estate clubby thing where you just have a bunch of house flippers. Like this is the
Mhm.
group that you want to take your spouse to. And most of the arrangements of people we have is maybe you fit this mold, you're the financial fanatic in your family. Your spouse, they trust you and that you do what you want to do, but they're not really too much into this type of stuff. And so they come to an event and they start to talk to maybe another spouse who is in a similar position or another member. And then they start talking about you have lazy equity in your house, you use a HELOC, you do this. And it's very common that they're like, hey, I was talking to John over there, and John was telling me about taking money to HELOC. Yeah, I think that's a good idea. We should do that. Oh, and you're like, damn it, I told you the same thing. You didn't listen to me.
That's exactly what happened when I explained my wife, and she went and do some research on her own, and the videos explain it in a different way. It's like exactly that's what I meant. And she's like, I didn't
Yeah,
understand it that way.
yeah. You just weren't as confident. Whatever.
Exactly.
Yeah, whatever.
But yeah, that's when I was looking at the itineraries on the agenda on the San Diego meetup. And there's some bullet points I mentioned about trust and LLCs and stuff like that. I'm like, okay, I'm wondering what they're talking about LLCs. So that's why I was I went down the rabbit hole of looking at LLCs. Does that make sense?
Yeah. What you start to realize is like the curriculum that we do, there's a finite scope to it. What I notice out there is that there's just a lot of noise in terms of financial products. For example, a lot of like irrevocable trusts or these solo 401ks floating around out there. It's the same dang thing. It's just there's all these marketable terms and there's these, they call them legal promoters or other promoters selling financial products or legal structures. It's all the
Yeah.
same thing and they're just marketable terms to make it
Yeah.
sound cool.
It makes me, I'm already a lawyer skeptic, but it makes me cringe when they start promoting and creating conferences or seminars and about around all this stuff, LLCs and asset protections and stuff like that. I'm like, oh my gosh,
Yeah.
lawyers are already bad enough, and now they're creating some kind of scheme to wheel people into fork out
Yeah.
$2,500.
And that's why it's just easier to like take for what I say with a grain of salt, right? But I am like any other investor. I've done my research, I've done my synthesis, I've done it, and I have lessons learned. You just take a few data points of similar to myself, and then you of people who've already made the synthesis themselves, and then it just expedites things a lot quicker too.
Yeah.
And if you can hear a lesson learned of a mistake, then hopefully that you don't have to make that mistake yourself.
So my question to you is, if you don't mind, how are you protecting your assets from creditors?
So that is in the is it in this eCourse? I think it's in I think a lot of you guys have the other eCourse for free where there's the legal section in there, but there's a diagram. Let me see if I can find it. You know, because here we are talking about LLCs, right? But I
Mhm.
said earlier, get your dang umbrella insurance up there first, right?
Yep. Yep.
But there's a level of how you build the defenses to your castle. It also might be at simplepassivecash.com/legal. So this diagram shows what a mess it all is, right? There's all
Yeah.
these things out there, but this is the not to be used as professional legal advice, of course. But the first thing is common sense. Don't be negligent. Be honest. Don't be an idiot, right? It's always
Mhm.
your first. That's free. And then insurance at the property. So we have insurance, of course, on our properties that's commercial grade. Our property managers also have insurance too, right? But on your guys' side, personally, you guys should have that also. Your car insurance and then umbrella insurance too. What I see a lot of people don't having. That's super cheap. It's like a few $100 for like $1 million. Now we're starting to get into stuff that you may or may not need. So energy structures and irrevocable trusts. And on this side, when does it trigger based on your net worth? It's not a hard and fast rule, right? These are guidelines, of course.
Right.
And then once your net worth climbs, now you start to get into irrevocable trusts. And then once you're starting to get complicated business or 8 figures, I would say, and you start to think about offshore trusts and equity stripping. It's the framework.
Okay. Is that part of the e-course?
This is in the passive investor accelerator eCourse. This is the big one.
Okay. I don't think I have access to that.
But yeah, that's the diagram. There you are right there. Like the secret is in the relationships and interacting with other people and then hearing best practices and piecing exactly. Then where the hell do I go for my irrevocable trust? That's where the relationships come from. Or like we teach about conservation easements. All right,
Mhm.
sounds good to me. Where the hell did I go? That's relationships. That's the missing part of this whole thing. But yeah, good question.
No, I appreciate the honest opinions and explanations around that. I guess it shortened the time period where I do my due diligence on should I get it or not? Is it worth it or not?
Yeah, yeah. And that's what I'm all about, right? If you have $500,000 doing nothing, you could be making 12%, and that's $6,500 a month or $1,500 a week.
Yeah,
Tops
you're right.
time's ticking. Time's being
That's that's
wasted.
that's what I want to make sure my money is not sitting around doing that.
It's
Thank you.
funny. Most of you guys like waste so much time. I mean, I do this all the time to myself, so I'm guilty of this.
I'm an engineer and it's my nature. I just dig into the data and I want to make sure I make the right decision.
But we all waste our time going to Costco to save $20 on gas. I save $20 on gas.
I do that.
Yeah.
Sorry.
And it seriously takes an hour or two out of your day, right? Where you in that hour, you probably could have just done a quick research, get the LLC done this, or deployed 100 grand out of your $500,000 and got it going, right?
Yeah.
I'll try and finish up here actually. So investing in a project, debt versus equity. Debt is a member loan that you're giving up. You don't get upside. It's usually it is less risk, but you don't get the upside there. Equity is you're taking on more risks, but that's where you're getting those higher returns. So typically investors looking to grow their net worth, certainly under $2 or $3 million, you have to grow your net worth. You got to get into equity deals. After that point, maybe you're cool with just 10, 12% on the debt side after that. But the important thing is you got to grow your base and principal. And for a lot of the methods that we do it is high paid day job, continually saving, but getting that money working for you on the equity side so you can grow your principal pile there. These last videos here, there's a lot of, like I mentioned earlier, like kids doing the burr strategy. Been there, done that. It's just, I think it's a huge mistake when I see an investor who lives in California borrowing properties in like Alabama. Everybody knows that you're just not there and they just can take advantage of you because you're the out-of-state investor. It's, you could potentially make more money, but man, it's just a matter of time before one of these guys just scam you, because a lot of people you work with are just like low net worth, low level contractors, where that's what I like on the commercial side. It's like not only the property managers head and shoulders better than residential property managers on the single family home residential side, but also like the contractors you deal with are so much more professional. Some FQs here. And I think that's the nice thing about you getting able to diversify your net worth, some more deeper learning. The family office, Ohana Mastermind, or FUM we call for short, is rather pricey and it changes. It always goes up. Just reach out to us, send us an email at team@simplepassivecashflow.com for more information and the current pricing. We always increase it like $5,000 every year. So I don't know when you're watching this video, but it's always going to be going up and up. But that's how we get the high level quality of it numbers. Right now in 2023, we have 105 members in there right now. It's a big initiation fee, but the renewals is like a fraction of the price. And if the quality of the group says anything, I would say 80% of the people renew for multiple years after that because they see the value. I scratch my head, like, what else more do you learn right after the first year? Because we take you guys through all this stuff more into detail and other things, of course. Why would you want to stay on for an additional year after the fact? Which is why the renewal price is like a fraction of the initiation fee. But again, it comes down to the relationships. We do a good job of filtering the right people. And at the end of the day, what's a few $1,000s for renewals each year if this is like the one kind of people that you actually resonate with, who actually is doing the same investing thing? And especially if you're a high income earner making over $300,000-$400,000, a lot of times we save you like $150,000 a year just in taxes alone, let alone not even anything with internet banking or with deals. That's a direct benefit right there. But yeah, reach out to team@simplepassivecashflow.com for family office Ohana information. And then yeah, I guess we'll see you guys next time. We'll go into section 2.